Welcome, American investors, to a deep dive into the current Bitcoin market, a landscape that has once again defied gravity, pushing past psychological barriers that seemed insurmountable just a few years ago. Today, on October 31, 2025, Bitcoin, BTC, is trading in a remarkably tight but high-altitude range, hovering around $109,000 to $110,000 mark. This price action, while seemingly stable, masks an astonishing volatility beneath the surface, fueled by a complex interplay of institutional adoption, shifting global liquidity, and the ever-present specter of U.S. Federal Reserve policy. The story of Bitcoin in late 2025 isn't just about price. It's about the definitive establishment of a new global monetary asset. The most shocking element of this current market cycle is the almost casual breach and sustained hold of the six-figure price tag. For years, $100,000 was the ultimate moonshot, a figure whispered by maximalists. Now it serves as a critical support level, a testament to the immense institutional capital that has flowed into the asset, largely facilitated by the successful launch and proliferation of Spot Bitcoin ETFs in the U.S. market. These ETFs have acted as a massive, compliant vacuum cleaner, sucking up supply and providing a pathway for traditional finance, TradFi, pension funds, and wealth managers to gain exposure without the custody nightmares. The daily flow data from these ETFs continues to be a primary bullish indicator, demonstrating sustained, non-speculative demand from a highly conservative investor base, a truly astounding development that few anticipated on this timeline. The macro puzzle: Fed policy and the dollar's influence. For the U.S. audience, no analysis of a risk asset like Bitcoin is complete without a laser focus on the Federal Reserve and the broader macro environment. October 2025 has been a month defined by central bank actions and cautious pronouncements. Despite a recent, widely anticipated 25 basis point rate cut by the Fed, a move meant to gently stimulate growth while managing residual inflation concerns, the market reaction has been surprisingly muted and at times negative for risk assets like crypto. The initial drop in Bitcoin toward the $106,400 support level immediately following the Fed's cautious stance underscored the tight correlation between crypto and broader risk-off sentiment. The key phrase from the Fed's commentary that rattled traders was the ambiguity around future rate cuts, pushing back on aggressive December easing expectations. This caution led to a surge in the crypto-Nasdaq correlation, which spiked to its highest level since June, highlighting that for all its digital gold rhetoric, Bitcoin remains tethered to the perceived risk appetite of the American equity market. Investors booked profits, fearing that a less dovish than hoped Fed could slow down the liquidity injection that historically fuels explosive crypto rallies. The $1.1 billion in long liquidations across major exchanges following the news was a painful but necessary reset. However, the longer-term outlook remains constructive. The very fact that the Fed is in a cutting cycle, even a cautious one, signals a shift toward quantitative easing that should, over time, improve overall liquidity. Historically, November has been one of Bitcoin's strongest months, and this seasonal pattern, coupled with increased whale activity, large transactions hitting a two-month high, paints a potentially bullish backdrop as we head into the final quarter of the year. The U.S. dollar index, DXY, remains a critical inverse indicator. Any sustained weakness in the dollar, perhaps driven by slowing economic data or a dovish pivot, would likely send a rush of capital into decentralized, scarce assets like BTC. The technical picture: navigating the tight range. From a purely technical standpoint, Bitcoin's current movement presents a fascinating study in consolidation at all-time high ranges. The short-term picture shows the asset trapped within an approximate horizontal trend channel. The immediate